Imagine two investors, Arthur and Julian, embarking on a 30-year financial journey with identical monthly contributions. Arthur meticulously constructs a portfolio brimming with dividend-paying stocks, delighting in the quarterly arrival. Dividend checks that make him feel as though he is already in a comfortable retirement. Julian, on the other hand, sees only a rising number on a screen, which often leaves him feeling like a passive observer, not an active participant. Arthur is convinced he is winning, and superficially, the evidence supports him. But is this perception truly accurate? The crucial discrepancy between the perceived gains of his passive income and its hidden annual costs in taxes, forfeited growth, and unseen opportunities is poised to challenge every notion you have ever held about dividend investing. Once we apply rigorous financial analysis, the outcome reveals a decisive winner by a margin that is far from negligible, and it is likely not the one you are expecting. To ensure a fair comparison, let's establish their identical starting conditions. Both Arthur and Julian are 30 years old, earning $75,000 annually, living in the same city, falling into the same tax bracket, and sharing the singular goal of accumulating wealth in a standard brokerage account for a comfortable retirement. Their paths diverge solely based on their chosen investment strategy. Arthur embarks on building a diversified dividend stock portfolio. Each month, he allocates $1,000 across a carefully selected mix of dividend aristocrats, companies renowned for consistently increasing their dividends for 25-plus years, such as Coca-Cola, Procter & Gamble, and Johnson & Johnson. To further boost his yield, he also incorporates high-yield exchange-traded funds, like SCHD and JEPI, alongside several real estate investment trusts. His calculated average dividend yield hovers around 4%. The regular arrival of tangible cash in his account every quarter, which he promptly invests, provides a strong psychological boost. It feels like an active, strategic endeavor, creating something substantial and real. Julian, conversely, opens an identical brokerage account but adopts an approach so straightforward it might almost seem simplistic, even embarrassingly so to some. He consistently invests $1,000 each month into VOO, Sentinel Capital's S&P 500 Index Fund. He abstains from researching individual companies or meticulously tracking dividend yields. Instead, he simply buys a slice of the entire United States stock market, then steps back and lets time do the heavy lifting. Arthur's colleagues, naturally, are captivated by his strategy, eager listeners to his tales of passive income, admiring the dividend payments arriving in his account, and absorbing his rationale for selecting specific holdings. Conversely, at a barbecue, you would be hard-pressed to find someone exclaiming, "Let me tell you about my index fund." It simply lacks excitement. It does not convey the image of a savvy, powerful investor. Yet feelings and financial realities often diverge dramatically. The ensuing 3 decades will meticulously dismantle every one of Arthur's foundational assumptions. In the initial years, Arthur's approach undeniably appears to be the more astute decision. By the close of year 1, Arthur's annual dividend income is already flowing. By year 3, it reaches $1,400, and by year 5, his portfolio is generating nearly $2,800 annually. The consistent quarterly arrival of money he did not actively earn serves as tangible validation, solidifying his belief in the strategy. Julian, however, by year 5, sees his VOO position swell to approximately $73,000. Yet no regular income streams materialize. There are no quarterly checks, no dividend notifications, no cash flow events whatsoever, just an expanding number on a screen. Arthur, brimming with anecdotes of his financial success, has engaging stories. Julian, in stark contrast, merely has a growing account balance. On every obvious measure, Arthur appears to be dominating. However, Arthur is blind to several critical realities. Firstly, every dividend payment he receives constitutes taxable income in the year it is distributed, regardless of whether he reinvests it or not. Secondly, this passive income is not new money manifesting from thin air. It is effectively a return of his own share value. This fundamental principle has been understood on Wall Street for 6 decades, yet Arthur's favored YouTube channels remain conspicuously silent on the matter. The illusion of effortless wealth is beginning to take shape, though Arthur remains oblivious. The dividend stock strategy is, in fact, one of the most vigorously promoted approaches in retail investing. And for good reason. The sensation of receiving regular cash flow is undeniably appealing. But a crucial distinction exists between cash flow and genuine wealth creation. The dividend strategy readily delivers the former, but it was never designed to guarantee the latter. Let's delve into a fundamental concept almost entirely omitted by dividend influencers: dividend irrelevance. When a company issues a dividend, its share price typically declines by an equivalent amount on the ex-dividend date. For instance, if a stock trading at $100 pays a $2 dividend, will open the next trading day at $98. You have not truly gained $2. Rather, you have simply reallocated $2 from your equity value into cash, on which you then owe taxes. Your original share price has decreased commensurately. This is not actual income. It is akin to a forced partial liquidation of your existing position. This is not a contentious viewpoint. It has been a cornerstone of established finance theory since Miller and Modigliani's seminal work in 1961. Naturally, your curated passive income content rarely, if ever, touches upon this. Beyond this, we encounter the annual tax drag. Every dividend Arthur collects is subject to taxation in the year it is received. Even with his diligent reinvestment of every penny, the IRS unfailingly claims its share each April. Qualified dividends originating from United States companies, held for a minimum of 60 days, benefit from lower long-term capital gains rates, 0%, 15%, or 20%, contingent on one's income bracket, a relatively favorable scenario. However, non-qualified dividends, which encompass most REITs and numerous high-yield ETFs, are taxed as ordinary income, mirroring paycheck rates, potentially reaching up to 37%. Given Arthur's pursuit of a robust 7 to 8% yield through REITs and JEPI, a substantial portion of his investment income is subjected to his full ordinary income tax rate. And now for the truly stark revelation of the mathematics. Over a 3-decade investment horizon, Arthur's dividend tax drag will cost him approximately 0.5% to 1% in annual returns. While this might sound insignificant, its impact is anything but. When compounded over 30 years, mere 1% drag translates into an astounding $300,000 in lost wealth, based on Arthur's consistent contributions. That is not a mere $30,000 or $50,000. It is a staggering $300,000. Next, we address the perilous practice of yield chasing. Usually high dividend yields often signal financial distress within a company, rather than robust health. Consider AT&T, which nearly halved its dividend in 2022 after years of being promoted. It's a fortress-like dividend stock. General Electric, once a paragon of dividend reliability in America, dramatically slashed its annual dividend from $1.24 per share to a mere penny. Wells Fargo reduced its dividend by 80% in 2020. Investors who pursued these elevated yields not only experienced a loss of income, but also a significant erosion of capital, as dividend cuts are almost invariably accompanied by plummeting share prices. Arthur's strategy fundamentally presumes dividend reliability, a notion that historical data consistently refutes. Furthermore, dividend portfolios inherently suffer from sector concentration. leaning heavily into financials, utilities, energy, and consumer staples. Consequently, they systematically underweight the technology sector, the very segment that has propelled the vast majority of United States market returns over the past 2 decades. Arthur, unknowingly, effectively opted out of the fastest-growing part of the market. Finally, we encounter the insidious, behavioral trap. The consistent arrival of a dividend check creates a powerful, comforting illusion of success. Strategy is fundamentally underperforming. Arthur's portfolio could trail the broader market by 1.5% annually for a decade, yet he would likely still perceive himself as winning, simply because the dividend payments continue to flow. This regular cash flow acts as a potent psychological smokescreen, effectively concealing underperformance from the one person who most urgently needed to recognize it. To present a truly balanced perspective, it would be disingenuous to highlight only the drawbacks of dividend stocks, as that would mirror the very accusation dividend influencers level against index investors, presenting only half the truth. Indeed, index funds come with their own legitimate limitations, which I will now candidly outline. Foremost among these is the absence of a direct income stream. Julian cannot sustain his lifestyle from his portfolio without actively selling shares. For an individual who values the psychological reassurance and predictability of a regular dividend check, this represents a significant concession. Furthermore, index funds are market capitalization weighted. Structural characteristic means that a concentrated group of mega-cap stocks, such as Apple, Microsoft, Nvidia, Amazon, and Alphabet, constitutes a disproportionately large segment of the entire index. Should this elite group experience a correction, the entire fund will inevitably feel the impact. While Julian owns the broad market, the reality is that the broad market itself is often far more concentrated than many investors perceive. Moreover, an index fund owns everything within its scope, including underperforming companies and even potentially overvalued firms caught in speculative bubbles. The index makes no qualitative judgments. It simply mirrors the market's holdings in proportion to their size. Sequence of returns risk is a very real concern for retirees. If a significant market crash coincides with the initial 5 years of Julian's retirement, the necessity of selling shares to cover living expenses becomes acutely painful. Liquidating assets at a loss to fund ongoing costs locks in permanent damage that even subsequent compounding struggles to fully mitigate. In contrast, dividend investors, at least theoretically, possess an income stream that does not necessitate selling off their principal. There is the boring problem. Lacking the comforting stream of dividend payments, investors are prone to panic selling during market downturns precisely because they do not have that tangible cash flow to anchor them. During the abrupt 34% drop of the S&P 500 in just 5 weeks in March 2020, those who successfully navigated the crisis were typically the ones adhering to a well-defined system. Those who merely watched a fluctuating balance were often the most likely to capitulate and sell at the market's nadir. Consequently, index investing demands a degree of personal discipline that dividend investing, through its regular payouts, implicitly fosters. These are legitimate, not fabricated drawbacks of index funds. However, observe how this list of limitations measures up against the one for dividend stocks. It is noticeably shorter. Its points are more situational. And critically, most are behavioral rather than purely mathematical. This is not an unfair bias on my part. It is the data itself starkly favoring one approach over the other. For the initial 5 years, the performance gap between Arthur and Julian remains imperceptible. The divergence begins to widen subtly, year after year, a gradual shift that Arthur's quarterly statements fail to explicitly highlight. By the 10th year, Arthur's dividend portfolio has appreciated to approximately $185,000. Meanwhile, Julian's index fund stands at around $205,000, a $20,000 lead. Arthur continues to receive his dividend checks, reinforcing his perception of winning. While his emotional scoreboard remains unchanged, the actual mathematical scoreboard has silently shifted in Julian's favor. By year 15, Arthur's portfolio totals $325,000, while Julian's has reached $380,000. The gap has expanded significantly to $55,000. Arthur, however, remains unaware of this growing disparity, as he is not benchmarking his portfolio against Julian's. Instead, he compares it only to his own portfolio from the previous year, a comparison that consistently appears favorable. With dividend checks now larger, yielding approximately $13,000 annually, Arthur feels a heightened sense that his strategy is increasingly fruitful. By year 20, Arthur's balance stands at $510,000. Julian's, however, has climbed to $620,000. The gap has now widened to a substantial $110,000. What accounts for this significant divergence? Three seemingly factors, each compounding relentlessly over time. First, an approximate 1% annual return drag. Historically, dividend-focused strategies have delivered annualized returns of about 9% over extended periods, whereas the S&P 500 has typically yielded closer to 10%. While that single percentage point difference seems negligible in any given year, over 2 decades, it represents the substantial chasm between $510,000 and $620,000. Second, the persistent tax drag. By this juncture, Arthur has remitted approximately $25,000 in dividend taxes, funds directly siphoned from his powerful compounding engine. Julian, in stark contrast, has paid almost nothing. His index funds inherently generate minimal taxable distributions due to their passive, on-trading nature. Third, the expense ratio disparity. Arthur's various dividend ETFs levy fees, ranging from 0.06% to 0.35%, whereas Julian's VOO charges a mere 0.03%. This seemingly minor difference also compounds significantly. Individually, each of these costs appears negligible, none proving dramatic in any single year. However, 3 subtle leaks, persistently draining over 240 consecutive months, variably transform into an astronomical sum, a financial loss Arthur could never have anticipated or even conceived, precisely because his account balance consistently trended upwards. Is the insidious nature of dividend stock underperformance. It does not manifest as outright losing. Instead, it feels like winning, just slightly less than one ought to be. And consistently winning slightly less for 3 decades is precisely how individuals find themselves confronting a 6-figure shortfall they are utterly unable to explain. After 3 decades of diligent investing, both Arthur and Julian reach retirement at age 60. Julian's index fund boasts a balance of approximately $1,780,000. Arthur's dividend portfolio, however, stands at roughly $1,410,000. This represents a staggering gap of about $370,000, a sum Arthur unknowingly forfeited, because his account statements always showed growth, and his regular dividend checks continually affirmed the perceived success of his strategy. Let's examine the cumulative federal taxes paid during their accumulation phase. Arthur remitted approximately $48,000 over 30 years due to dividend taxation. Julian, conversely, paid a mere $3,000. This $45,000 difference represents funds Arthur funneled to the IRS that Julian kept actively compounding. But the ramifications of their strategies extend beyond accumulation. They profoundly impact estate planning. Should Julian pass away holding his index fund and bequeath it to his children, they will inherit it with a step up in basis. This crucial provision resets the cost basis of the assets to their value on the date of death, effectively erasing decades of accumulated capital gains. Julian's heirs could liquidate the entire portfolio the very next day and owe absolutely nothing in federal capital gains tax. Arthur's portfolio, however, has been taxed year after year throughout its existence, and there is no equivalent recovery for those prior tax payments. The initial inherited dollar amount might be similar, but the after-tax outcome is dramatically different. Arthur's underperformance was not a consequence of dividends being intrinsically poor investments. Rather, he lost ground because three subtle yet persistent leaks, return drag, tax drag, and expense drag, operated concurrently for 360 consecutive months. He failed to detect any of them in isolation during any given month. Yet by the 360th month, their combined impact had cost him the equivalent of a fully paid-off house. The narrative takes another compelling turn. Both Arthur and Julian are 65, retired, and require $50,000 annually for their living expenses. Arthur's dividend portfolio, by this stage, is generating approximately $56,000 in annual dividends. He enjoys the psychological comfort of not having to sell a single share. The cash simply appears in his account. Ostensibly, it seems he finally wins this. However, Arthur is obligated to pay taxes on every dollar of these dividends in the year they are received, regardless of whether he wished them to be taxed then. With a blend of qualified and non-qualified dividends, after federal taxes, Arthur will net roughly $48,000 to $50,000 from his $56,000 dividend income. Julian, conversely, must sell shares from his portfolio to finance his $50,000 in annual living expenses. Superficially, this strategy appears disadvantageous, seemingly depleting his principal. Yet, a critical advantage often goes unmentioned. Julian possesses absolute control over when and how much capital gains he chooses to realize. Single filers in 2026, long-term capital gains tax brackets offer a 0% rate on gains up to approximately $48,350, 15% up to about $533,400, and 20% beyond that. Having held his shares for over 30 years, the vast majority of Julian's portfolio value consists of unrealized capital gains. When he sells $50,000 worth of shares, only a portion, for example, $40,000, represents actual capital gain, with the remainder being a return of his original investment. By meticulously managing his withdrawals, Julian can strategically keep his realized gains below that 0% bracket threshold. Consequently, his federal tax liability on a $50,000 retirement income year could be close to zero, allowing him to effectively take home the entire $50,000. Arthur's tax burden on his $56,000 in dividends would amount to roughly $6,000, $8,000 in federal taxes alone, excluding any state taxes. The same retirement lifestyle, yet a drastically different tax outcome. Moreover, this does not even count for Julian's additional $370,000 in principal, which continues to work and compound for him for the rest of his life. The dividend strategy, which initially seemed like the clear winner for income generation, ultimately falls short in this critical retirement income comparison as well. To avoid the very bias I have criticized, it's crucial to acknowledge that there are specific, legitimate scenarios where dividend stocks indeed make sound financial sense. These situations are far more constrained than what ubiquitous YouTube algorithms might suggest, but they are nevertheless real. Within a tax-advantaged account like a Roth IRA or 401k, the entirety of the critique I have just presented collapses. The annual tax drag, which represents the single most significant cost of dividend investing in a taxable account, vanishes completely. Dividends held within a Roth IRA are never taxed. Dividend exposure is desired, this is precisely where it belongs, not in a taxable brokerage account. Furthermore, for retirees who genuinely prioritize the peace of mind that comes from not having to sell shares, dividends offer a unique psychological certainty that index funds cannot replicate. There's undeniable value in avoiding the monthly dilemma of, what should I sell? When you're 82 years old. While this is not a mathematical advantage, it is a powerful behavioral one, and behavioral advantages are profoundly real, often being the primary reason why most people ultimately falter in their investing journeys. Indeed, if the consistent stream of dividend checks proved instrumental in keeping you invested through market turbulence like the 2008 financial crisis or the 2020 crash, when you might otherwise have panic sold an index fund, then the behavioral advantage of dividend investing could genuinely eclipse its mathematical shortcomings. Ultimately, the most effective strategy is the one you are disciplined enough to adhere to. Specifically, dividend growth stocks, companies categorized as dividend aristocrats, for their remarkable track record of raising dividends for 25 or more consecutive years, historically provided robust returns with comparatively lower volatility than the broader market. As a complement to a foundational index position, they represent a defensible allocation. The operative word here is complement, not replacement. Step 1. During your wealth accumulation years, build your core portfolio using low-cost index funds such as VOO, VTI, or a comparable total market fund. This is where the mathematical advantages are undeniable, period. These funds offer lower taxes, reduced fees, superior diversification, historically higher returns, and complete control over when you realize gains. Step 2. If you desire dividend exposure, ensure it resides within tax-advantaged accounts. Roth IRA, for instance, serves as the ideal vehicle for dividend stocks. Step 3. As you draw closer to retirement, within 5 to 10 years of your planned exit, you can strategically reallocate a portion of your portfolio towards dividend growth stocks, primarily for enhanced income stability. Crucially, this is intended as a complement to your core index holdings, not a wholesale replacement. The true trap is not dividend stocks themselves. Instead, it is the pervasive narrative that frames passive income as the ultimate financial objective, when in reality, total return is the genuine goal. Dividends are not, and never have been, free money. Every dollar of dividend income you received this year came with a cost. In taxes, in forfeited growth, and in compounding potential you can never recover. If you're curious how either of these strategies compares to simply buying and holding a single high-growth stock for 3 decades, that's an entirely different discussion. And the mathematical findings there might surprise you even further.